Recently, geopolitical tensions in the Middle East have escalated significantly. As news, analysis, and commentary continue to emerge, along with fluctuations in oil prices, markets have begun to experience sharp volatility. The most common questions I've been receiving from investors are, will the market continue to decline? Should I sell now? Is this a good opportunity to add more? But my response may be different from what you expect. At times like this, the most important issue is not whether to buy or sell. Because when uncertainty reaches the level of war and geopolitical conflict, short-term market movements become extremely difficult to predict. What truly matters is how well you can manage your emotions and your wealth structure. What is the real issue behind these questions? Behind these questions lies a common emotional state: uncertainty, anxiety, and the urge to act. This is completely natural. But the problem is, when decisions are made in this state, investors are far more likely to react emotionally, selling at lows and chasing during rebounds. It may feel like managing risk, but it can resemble reactive decision-making rather than disciplined investing. 2. What is the right question to ask? So, in moments like this, a more important question is, if the situation continues to evolve, do I can respond? If the conflict escalates and markets remain volatile, or if tensions ease and markets rebound quickly, do you have room to respond in either scenario? At its core, this comes down to one thing: is your wealth structure capable of handling different outcomes? 3. What does it mean when structure cannot respond? Let me illustrate this with several common situations that often emerge in environments like this. Scenario 1. Lack of liquidity more likely to be triggered during periods of uncertainty. Some families have substantial assets, but nearly all of them are invested in the market. If market volatility is combined with real-life uncertainties, such as job changes, major family expenses, or cross-border capital needs, they may be forced to sell assets during market fluctuations. This is not a mistake in judgment. It is a structural issue. There is no capacity to wait. A professional advisor may help by setting aside 6-12 months of cash or cash equivalents, separating short-term needs from long-term investments, helping reduce the likelihood that external shocks significantly impact core assets. Scenario 2. Overconcentration conflict amplifies single sources of risk. If a large portion of a portfolio is concentrated in a single market or sector such as technology, geopolitical events affecting specific regions or supply chains can cause synchronized portfolio volatility. A professional advisor would diversify across markets and asset classes, control exposure to single risk factors, use rebalancing to reduce deviations over time. The goal is not diversification for its own sake, but to avoid a situation where one event determines the outcome of your entire wealth. Scenario 3. Lack of stabilizers. During periods of conflict, news flow intensifies and emotional reactions become stronger. If a portfolio consists entirely of high volatility assets, you are not only experiencing market fluctuations, but you are also absorbing the psychological impact of constant information flow. An advisor may consider introduce lower volatility assets such as cash or bonds, clearly define the role of each asset. Growth vs. stability. Some assets are not designed to maximize returns, they are designed to help you avoid making mistakes in uncertain environments. Scenario 4. Loss of optionality. Many investors say, if the market drops further, I will add more. But either all capital has already been deployed, or emotionally, they are no longer willing to invest. When the opportunity truly arises, they are unable to act. This is one of the most overlooked risks. A professional advisor helps you design a phased investment approach, preserve capital for future opportunities, replace reactive decisions with predefined rules. At its core, this reflects a key principle: uncertainty itself is not the risk, losing optionality is. 4. The real role of a professional advisor. During periods of significant market volatility, the role of an advisor can become particularly important. Because the value of a professional advisor is not to predict the outcome of geopolitical conflicts or call market bottoms. It is to help you make the right structural decisions, designing liquidity so you are not forced to sell due to external events, controlling risk sources so no single event dominates your outcomes, building stabilizers so help support more disciplined decision-making, preserving optionality so you can still move forward or step back when needed. In one sentence, the goal is not to predict a single outcome, but to prepare you for multiple outcomes. So, when you return to the original questions, should I sell? Should I add more? You should first ask yourself, does my structure allow me to make this decision? If your structure is sound, you can act gradually and with discipline. If your structure is fragile, any action may amplify risk. Mature investors understand, when certainty is high, investing is about choice. When uncertainty is high, wealth management is about structure and judgment. In today's highly uncertain environment, if you would like to evaluate whether your current structure is appropriate, I've prepared a simple checklist to help you quickly assess your situation. You may consider discussing your situation with a qualified financial professional. See you next time.